I got a couple thoughts on the S&Ps, and actually after these couple of graphs, and we'll move into the gold market. What I have some charts on that, and they're mostly long term, but short term, we'll take a look at some charts on the first chart. This is about the SP or the SPX or SPYs, but it's a VIX chart, and VIX sometimes can really on a bigger time frame show what to in general. VIX moves opposite of the SPN or SPX or SPYs. So if you get a divergence, like both are going down, then that's a divergence. Both going up, then that's a divergence. But I want to point out a couple of different divergences over the last 6 months or so that the VIX showed some actually pretty accurate signals back in the October time frame, right off that September top. The SPYs in this time frame here, the SPYs was making lower lows. If you notice, the up here, the VIX, this is the VIX up here, this is SPY down here, it just basically matched its previous highs, and I just took basically the close to close. But that was a bullish divergence, even though the SPYs was making lower lows. The VIX actually just matched this previous high, and that's a bullish divergence. That's suspected that since the divergence was positive here, we expect a short-term bounce on the SPYs, and that's exactly what happened. And remember, everybody remembers the December decline. Well, the VIX actually, I didn't trade off of it, but the VIX actually gave a warning sign, even though the SPYs here made a double bottom in early December compared to its November low, which is double bottom. The VIX made a higher low, showing that there was a divergence. In other words, volatility is going to increase. Well, volatility did increase. It actually went to the downside. So that was one edge that the VIX did pick out, these two examples. One was a bullish divergence here at the October low, and at the December low is a bearish divergence. The VIX made a higher high, so it helped predict that the market went down. Well, recently, the VIX actually broke below its November. Now, let me change the color here, 1 second. Change it to a blue. Right here, we got, this is a VIX. If you notice, the VIX broke below its December low compared to this low. If you notice, we're basically S&Ps wise just matching those, is matching its previous high of December high. So this is, in our opinion, like a huge divergence. I'm not saying we can have a short-term pullback here. We are running into resistance at that 2,800 area, or 280 at the SPYs. But the VIX is suggesting we are going to actually break through that high at some point, because the VIX actually broke below its December low, suggesting that the SPY will break above its December high. So I just want to point that divergence out. When it's kind of a longer term divergence, because that December high is basically what, 3 months ago. So it's a bigger divergence, but we're taking this sign, this VIX divergence, as a bullish sign on a longer term basis. So, and we got another chart here that kind of suggests a bullish resolution also, which is basically the tick chart. The top window is a 100-hour moving average of the tick. The middle chart here is the this chart right here is the SPX. This is the chart below the SPX, and this is a cumulative tick with the 70 moving average. So when it crosses above that 7 moving average, the bullish signal, and below it, the bearish signal. But and the bottom window is just the 30 hourly moving average. So it moves a lot quicker. But I wanted to point out some previous signals by this. But back in February of 2018, the ticks fell, the 100-hour moving tick fell below zero. Well, that was a pretty good signal, as we did get that decline. And also the cumulative tick fell below its 70-day or 70-hour moving average, which is also a confirmation. The next major signal came in would be March. March, if you notice there, it crossed its moving average. There's crossed its moving average. It both gave sell signals, and the market pretty much tumbled in concert. Back in the September high, the tick started, the 100-hour tick started to go negative. Basically, in early September, it looks like about the first week of September, stayed negative, even though the SPX gained ground. So that was a major divergence. And also the cumulative tick was also moving down in early September, warning that the current rally was not going to continue. Well, in general, the tick stayed negative until just recently, until about January 1st of 2019, and finally got back above zero. So the market has rallied quite a bit off its lows. But anyhow, all through that decline from September to late December, the ticks was either cumulative tick was moving down, and the 100-hour moving tick, in essence, stayed below zero. So that was a major find. We do a lot of work with ticks. A lot of times we try to find examples where ticks work consistently, and this is starting to look like it's going to work consistently. Right now, if you notice, the SPX is still making around 2,800 on the SPX. The previous high is around 2,950. So right now it has made lower highs. But if you notice, the cumulative tick is back at its previous highs of September of last year. So it's kind of a leading indicator. We did roll over here a little bit, warning that it could be a bearish crossover here, but the cumulative tick is testing its previous high, suggesting that the SPX may get back to its previous high. The 100-hour tick is still above zero. So even though the market's kind of hesitating here, the tick has not gave a bearish signal, at least not yet. The 30-hour tick has, but it gyrates quite fast above the tick and below zero. If the signal, if the 100-hour tick actually did fall below zero, that would be a bearish sign for the SPX. And so far, that has not happened. So what we're thinking, what may develop here, is no really significant decline. We may pull back a little bit, but we had thought at one point we might pull back down to bottom of this trading range down here around, give or take 20, looks like about 2650. We thought market might move down there, but the way the ticks are holding up here, it does suggest some strength in the market. But you know, the ticks could get weak here in the coming days, and we'll change our tune. But as it sits right now, the market looks pretty steady. If we start seeing uptick readings with the market going flat, that would actually be a bullish sign. We actually start seeing downtick readings with the market being flat. That's a warning sign that a decline may come. But as it sets, we think, in our view, it's not a good idea to look for a short position here, because the 100-hour tick, and actually even though the cumulative tick is still trending up, it's showing a little bit of weakness here, but really hasn't turned down yet. So on a near-term basis, we're at 2,800 on the SPX. That is resistance, but the ticks are not giving a bearish sign here so far. So we don't have, we definitely don't have a sell signal. So we think the market may just bounce around this trading range here. So that's what we wanted to point out, with the VIX kind of giving a longer-term bullish sign, because it's showing a bullish divergence. It went lower than its December high, predicting that the SPY will break above its December high, and the tick's not showing weakness here. So we're kind of, if we do get a consolidation here, and the ticks don't get wild to the downside, we'll think we'll end up with a buy signal. But as of right now, we don't have a buy signal. So anyhow, that's our view on the VIX and ticks. I just want to point that out.
Hey, Tim.
Yep.
Can I go back to the VIX? Can I show you a chart on the VIX?
Sure.
And then you can take the screen back. But I just wanted to show you a chart on the VIX. I think you might find this interesting. I think it adds to some of what you were talking about there. All right, so I've pulled up my chart here. Now, this is the S&P 500. This is a weekly chart that goes back the last 30 years, so all the way back to 1989.
Okay.
And what I wanted to do was to point out down the bottom here is the VIX. Now, this is a weekly chart. So, and these are going to be weekly closes essentially. But what I've discussed a lot on Market Watchers Live and some of the research that I've done, what I have found is that when you get into these bear market environments, that bear markets need fear and so forth, kind of like a tornado needs rotation. And when you go back and you take a look at some of the prior bear markets, now this was a cyclical bear market back in 1990. It was during the secular bull that we had, but this is where we fell more than 20% back in 1990. You can see that the VIX did
held high. Yeah.
VIX did 15, 16. And then 1998, that was the next cyclical bear within the secular bull. And at that point, we once again did not see the VIX go below 16. Throughout the secular bear that we had in 2000 to 2002 and also 2007 to 2009, we never saw, during rallies, we never saw the VIX drop back down below that 16 area. And so when I was looking at this one, first, this is the what I consider to be a cyclical bear. I believe we're in a secular bull. So I'm looking at this now, much like I looked at this drop back in 98 and this drop back in 90. I don't believe we're in what we were in 2000, 2002, 2007, 2009. I believe the market goes a lot higher from here over the next several years. So I'm looking for more of a shallow bear market, a cyclical bear. And I think this pullback now on the VIX down below the 16 level, it's unlike anything we had seen in these other, bear market periods. And I think that's further confirmation that we're moving back into bull market mode. Do you have any comments on that?
Yeah, actually, you're seeing the same thing I'm seeing. The VIX is actually making lower lows, and the SPYs are. I think VIX kind of. You're right. Your long term. Yeah, I see the same thing. I think basically the decline is done. I don't know if to me, I think we've probably seen a V bottom in the SPX, because I don't see any reason at the moment to suggest we're going to go down and even test that level. At least not yet. The ticks are not giving any signals here, and the VIX, is remaining low, like you said, below 16. Mm-hmm. So to me, that's a longer term bullish sign. I think over the next couple of months, after this short term consolidation, wherever it leads, I don't think it leads much to the downside. We're probably going to start chugging higher again.
Yeah, and it's hard. It's hard to see it on this long-term chart because these weekly prices are kind of scrunched together here. But both in 1990 and 98, in these cyclical bear markets, we did bounce and have pretty nice bounces, and then go back down and either test the initial low or even break down below. Here, you can't see it because it's a weekly close, but intraday we went back down and we actually tested that prior low. So my initial thoughts were, when we went down, we'd probably come back up, bounce 10 or 12, 13%, similar to what we did back then, and then go back down maybe and put a double bottom in. But I don't know. The way it looks to me with the volatility dropping so far, this, a bear market or, weakness requires a lot of fear, and the market's not selling off. We're not getting those impulsive drops in the market. It just seems like we got a different market environment now than we've had, certainly than what we had back in 2007, 2009, and 2000 to 2002, because volatility never went below 16 back then.
Right.
We've been trading below that level now for a little bit.
Well, that argues well with the possible V bottom. If we're going to make a V bottom, we probably would have held above 16. And right now, at least on the VIX, holding above 16, and we're not doing that. We fell below 16. So it kind of argues that could have been just a V bottom. But, time will tell. But it does look bullish. So
yeah, of course, as soon as I think I have everything figured out in the market, that's when the market throws a curveball and everything.
Yeah, there's gonna be a curveball in there. But so
of course,
right, well, I'll let you.
That's what I'm waiting for.
Curveball.
Yes.
Yeah, I'm kind of in the deal. I think the bottom's probably in. Things could change quickly over the next 30 days, and all these semi-bullish signs could give way. The VIX could start spiking up for some reason. But as it says right now, if I had to be in the position, I'd be along the SPX. But I don't think this is really a good time to do it right now. But it could be, if we do get a minor pullback over the next week or two, it could end up with a buy signal. But
hey, Tim, I do have a question for you from the chat room. What is the tick indicator?
Ticks actually measure any given time the number of stocks in the NYSE are either on an uptick. In other words, last trade was 20 and an eighth, moved to 28, or 20 to 20 and an eighth. That's an uptick because the market last trade was a gain. And it takes all, I guess, 3,500 stocks in NYSE, and it measures all those stocks that are either on an uptick or a downtick, and accumulates. So at any given time, when you have like I said, I had 650 uptick readings. In others, out of those 3,500 stocks in NYSE, 3,500 or 650 of those stocks were in upticks, either combined on everything. So
Tim, if you don't mind, if you could take that screen back. I don't know if you were showing the tick on your charts.
Okay.
No one could see it.
Yeah, I didn't know I could do that. I thought I had to share. Okay.
There you go.
But, yeah, excellent. But anyhow, the ticks, actually the easiest, best definition is actually go and just Google NYSE tick. I'll give you the best definition. But it measures basically the upticks and downticks of NYSE stocks, and it does cumulative of them. So in an up market, normally you have more upticks readings because the market's trending up. In a down market, you have more downticks because the market's trending down. So the cue is when you have markets kind of going sideways and you see a bunch of downtick readings on the tick indicator, that's more of a suggesting that at some point the market's going to start working lower. So, but anyhow, that's my tick indicator stuff right now, which is actually showing not bearish, but it's almost neutral readings on the ticks, but it is giving longer term bullish signs, as the cumulative tick did get back to the September highs, where the SPX has not. So if the ticks are foretelling the future, the S&Ps at some point should get back to the September highs, and possibly from there we may keep going. So anyhow, I wanted to point that VIX and tick thing out, and it's a good indicator to use. Another thing we want to point out is actually gold. Gold has this bull and bear markets, and we think we're probably at an important stage right now. We kind of watch, this is a monthly chart of gold going back to 1988. And what we want to point out on this chart, when the RSI is above 50, gold's in an uptrend. When it's below 50, it's a downtrend. And the top window there is the RSI. And so the blue area or green area, when it's above 50, we highlighted that, and it shows what the market did. And when it's below 50, it's usually the market's declining. And it flipped, RSI flipped to a bullish reading back in 2001 and stayed above RSI 50 all the way into about 2013, flipped below zero. From 2013 to 2015, it stayed below zero. And it kind of went back and forth here over the last 3 years. And now we're back above, RSI is back above 50 again. This is on a monthly time frame. So gold, according to RSI rules, is an uptrend right now. And it flipped back up, I think it was in January, as far as the RSI is concerned. The bottom window is a Bollinger Band spread. In other words, when the Bollinger Bands push together, volatility in the market's really narrow. And normally narrow volatility predicts the market will increase its volatility. In other words, after a sideways consolidation, an impulse wave will start either up or down. And the Bollinger Bands width measured that volatility, spread of that volatility. So the lower the volatility predicts that the market's going to start an impulse wave, could be either up or down. But back in 1993, volatility got extremely low, below 13. We're around 13, and the RSI flipped above 50, giving a bullish signal. So the market jumped up a little bit back in 93. Also did the same thing, low volatility going into that low of 2001, 2002. RSI jumps above 50, giving a signal there. Well, volatility again, Bollinger Band width got extremely narrow again, below 13. We're at 13.85 right now, and RSI flipped above 50. So it has been low volatility for quite a long time here, for actually looks like a couple of years, part of 17, all of 18 and 19, and RSI flipped above 50. So this method is on a buy signal right now. Okay, this is the same chart. I just took the price off. And what I have here is just a moving average of a 5-period, 8-period, and a 3-period moving average of the monthly chart. And all I want to show is basically bullish and bearish crossovers. So right there, call it January 1st, all those moving averages crossed up together. So the moving average method is also on a buy signal, approximately the same time the RSI jumped above 50. It's just another method of a short-term buy signal. So the monthly gold right now is on a buy signal on RSI method, along with the Bollinger Band spread suggesting a large move is coming, and the moving average is on a buy signal. I'll flip to another chart. Here's a shorter-term chart. This is GLD, the ETF for gold. And what we wanted to point out here, there's potential head and shoulders bottom forming here. We're right smack at the neckline right now. RSI is above 50. You can kind of see it easier there. And Weisskopf, to get through a resistance level, Weisskopf, which is a 1930s technician, wrote the Weisskopf method, his book. Suggests to get through a resistance line, the market needs a sign of strength, what he calls a sign of strength, which is SOS. And that's basically a large price move with high volume passing through a resistance area. So around 130 on the on GLD, we'll need a sign of strength. Well, the market's been up 4 months in a row already. So we're seeing some strength right now, but in our opinion, we're probably going to see a lot more strength on a short-term basis. We're talking probably within the next 3 months, that to get through the 130, we're going to need a sign of strength through this area. So it could happen sooner, it could happen next week, it could happen next month, but we think it'll probably happen before May. It will probably bust through the 130. And, you know, this head and shoulders bottom, if you do the measurements on it, it has an upside projection around 160, which is basically in this range right up, this range right up here. So we would project on a minimum basis, just with the measurement of the head and shoulders bottom, a target of around 160 on the SPYs. Here's a silver gold ratio at the bottom. We'll actually look at it, a future chart here, but it's also signaling kind of a bullish reading. This is not it, but this is a cycle on gold. There's a 15-year cycle. Gave a bull market buy signal in late, looks like 1985. Gave a bullish signal right around the 2000 level. 2016, that picked out that major low. And top of the cycle is usually about 7-8 years later. So this 15-year cycle has a projection high somewhere around 2023, give or take. But in general, we think the market could move higher into that time frame. We also noticed we did a Fibonacci level here. The market stopped at the 50% retracement level. And normally the market only retraces 50% of its last previous rally. At least goes back to make a double high, and possibly it could move much higher. If it moved down to 61.8% retracement, which is around the 900 level, at most it would make a previous high. So we're looking, according to the retracement rule of 50%, they should get back at least back to the 1900 level by 2023, possibly more. We don't know yet. But there's also an 8-year cycle high, which came in basically 2016, pretty much close to the 2015 high. So there's an 8-year cycle and a 15-year cycle high that hit in 16. So we don't think the cycle theory suggests that in general, over the next 3 years, we still may move higher here. Okay. Oh, this is a silver gold ratio. Okay. Yeah, this is a silver gold ratio. Normally when the silver gold ratio, which is this chart right here, is when it gets down around 0.013, usually major lows have formed. In bear markets, silver underperforms gold. In bull markets, silver outperforms gold. So in general, we expect silver to actually start outperforming gold. And one of the reasons why is silver relative to gold is extremely cheap. The last time it got this ratio got this low, it was a 2003 low, it was a 2008 low, and a 2016 low. And we've been down here, the silver gold ratio, for about the last 4 or 5 months now, and it hadn't really moved off that low. And this is going to be typically when the bull market starts, silver should start outperforming gold. When it gets up to around 0.02, you have to worry. The last time that happened was back in 2006, 2007, and 2008. Here it just went bonkers. I mean, that was phenomenal there. But anyhow, if it gets back to around 0.02, that could be a bearish sign for both silver and gold, but we're a long ways from that right now. The bottom window is a Bollinger Band width again. When it gets narrow, below 25, it suggests an impulse wave is about to start. Well, the Bollinger Bands has been staying below 25 for the last 4, 5, 6 months. So volatility has been extremely low for silver. The last time we got this low was basically at that bottom of 2016, and again back in 2003 it got this low. So we should start seeing volatility, price movement in silver to expand here. In our view, it's probably already started because the RSI and gold is above 50. RSI for silver, and this is a monthly chart, is just, well, it's actually there it is, 47.75. So it hasn't gone above, this is a monthly chart, it hasn't gone above 50 yet, but it's heading in the right direction, you might say. One more chart here. This is GDX, and it's RSI is on a daily time frame, and we're right smack into the big part of the trading range. We fell below it. If the market can't hold its previous lows, which it did fall below it here, it'll attempt to take out the previous high. So the minimum upside target on GDX on a short-term basis, we think, is 25. It could head higher than that, but RSI is above 50 on the daily time frame. So at the moment, we have to say GDX is still in an uptrend here. So I know I'm running overtime here, so I can hand it back to you, Tom.
Tim, it was a pleasure having you on here, always is, and we'd love to have you back soon.
All right, I hope you invite me back. I'll come back anytime, and thanks for having me on.
All right, thank you.
Excellent.
Thank you.